This is just a short note going through the company question, Melba PLC, and the note we're looking at is VAT included in fixed assets. So the note here is a new warehouse was purchased during the year for 100,000 plus VAT of 13%. So 100,000 plus 13% VAT, therefore the VAT's obviously 13,000. The amount paid to the vendor was entered into the buildings account, no entry was made in the VAT account. So a couple of things just to understand very quickly here. The amount paid, when you pay for something, you pay the VAT as well. So the amount paid to the vendor is going to be the 113%, the 100% plus the VAT of 13. Therefore, the 113,000 is the amount that we paid. This was entered into the buildings account. So this is what my buildings account looked like at the start of the year. It's 713,000. And I'm just trying to show you this just to break down how you'd get to that figure. So the X's here represent the multiple buildings that the company would have purchased over the last couple of years. And when we do this, we include every building at its cost value. The last building we've included here is the 113,000 because we were told that the amount paid was entered into the buildings account. However, it's not the amount you pay that determines the value of the buildings, it's the actual cost. So the actual cost of this building was 100,000. When we do accounting and we have things like VAT, we take the VAT out of everything and we keep it separate, just like we try to separate everything as much as possible, and we have our separate tally for VAT. So the VAT should never be included here. The only other time VAT will be included in additional accounts is bank, in terms of or paying someone. So in terms of looking at it from a creditor's perspective, if you haven't paid them yet, or from a bank perspective if you have. But in terms of valuing of other expenses and assets, VAT will never go in here. It'll just accumulate separately. So all these figures that go into the buildings account should only be at their cost value. Therefore, obviously, to get to 713,000, I've included VAT here. So what am I going to do? I'm going to take away the VAT. So the VAT has to go out of this. 13,000 is gone. And the reason I do so is because VAT has its own separate account, and it's never included in a fixed asset. So that's maybe one thing, if you weren't familiar with that, just to write that down, because this is a small note, it's a quick note, but it's one that I'm guessing confused a couple of people. VAT should never be included at the cost. It should never be included at the cost amount. So if you kind of think about it, I mean, tax is something you pay. It should never determine the value of your company. So let's say the tax in France is quite high, and you buy buildings in France. Just because you paid more money for those buildings because you paid a bunch of tax, doesn't make that tax. It doesn't mean that tax increases the value of your buildings. It doesn't mean the tax increases the value of your company, because if they increase the value of your buildings, they will increase the value of your company here. It doesn't. It really is just seen as a form of it's a nuisance, it's an expense you have to pay, but it never increases the cost of a fixed asset. I just kind of wanted to go through that in a little bit of detail rather than just sending you this. The VAT account is a separate. The next thing we have to do. Again, I'll try to go through in a little bit of detail because it's very quickly just to show the marking scheme. The amount that we're given in the question is a balance of VAT on the credit side. It's a liability. We owe 5,000. So what's happening? Well, just to think about it in terms of what we've done with our buildings account, our balance was 713,000. I mean, technically, we've gone and we've taken we took 13,000 away from that balance to get us 700,000 for buildings. So obviously if I put VAT here on the credit side of the buildings account, the double entry will be to debit that VAT in the VAT account. Everything has to have an opposing entry, that's why we have a balance at the bottom. But the way to think about the VAT account, the way to try to understand the VAT account, is the VAT account is there generally to show most companies how much they owe the government. So you owe 5,000, and every other time you are involved with having to pay more VAT, and you owe more VAT, you increase the amount of VAT that you owe, you increase the amount of VAT that's on your credit side. Every time you pay VAT, that's now gone, and it reduces the value of what you owe. And at the end of the year, if you've paid the government 100,000 in VAT this year, and you owe 80,000, they'll look at it and say, do you know what? This person has paid us an extra 20,000 than what they originally owed. They're going to get tax back. They're going to get a form of VAT back. It doesn't happen all the time, but it does happen. In this case, we actually paid the VAT earlier on in the year. We paid the VAT. It was paid to the vendor. So the 13,000 will actually reduce the amount of VAT that I owe. I'm not going to pay the government 13,000 here, and then later on they'll tell me I owe 5,000. They just subtotal the two. So 13,000 goes on the debit side of the VAT account. Every time you pay VAT, it's the debit side of the VAT account. Every time you owe VAT, it is the credit side. So at the end, my balance is going to be the subtotal of 8,000. On the debit side, it's a current asset.